Usually when we look at the economy, there's this expectation of basic physics, like gravity.
Right,
You
yeah.
drop an apple, it falls to the floor, you raise the cost of borrowing money, people stop buying things, and prices go down. It's supposed to be clean, it's supposed to be this objective, predictable chain of events.
Which is incredibly comforting, when you're making major life decisions. I mean, we all want the math to behave exactly the way the textbooks say it should.
Oh, absolutely. But then you step into the 2026 housing market, and suddenly you drop the apple, and it just hovers in midair.
Yeah, completely defies gravity.
Exactly. You raise the cost of borrowing money, but home prices somehow keep climbing, inventory stays locked up, and your wallet practically catches on fire. It's a market that seems to be completely ignoring the laws of economic physics right now.
It really does feel that way.
So, welcome to the Deep Dive. Today our mission is to decode this bizarre, deeply contradictory real estate landscape for you. We've got a massive stack of sources today. I mean, we're talking Federal Reserve data, FRED, Freddie Mac's primary mortgage market survey.
Yep, the National Association of Realtors bank rate.
Right, Realtor.com's 2026 forecast, and even a really fascinating look into a luxury micro-market on the Highlands-Cashiers Plateau with Carrie Bateman. Because if you are trying to buy your first home right now, or you're looking to sell, or you just want to understand why everything feels so chaotic, you are probably dealing with some major whiplash.
Oh, the whiplash is entirely justified. I mean, the contradictions we are seeing right now in the data, they are glaring, and they're causing a lot of anxiety for people.
For sure.
But our goal today isn't to make aggressive doom and gloom market predictions. We really want to look calmly at historical cycles, the underlying structural reality of the data, and how real estate is functioning today as both a financial asset and a lifestyle choice.
Right. Because the central contradiction we need to solve is this: buying a home right now feels painfully difficult for the average person. It feels like this massive uphill battle. Yet the macroeconomic data insists that affordability is actually improving and sales are starting to tick up.
Which sounds completely made up if you're out there house hunting.
Right. I want to figure out how on earth both of those things can be true at the exact same time. But to do that, I think we have to start with the psychology of mortgage rates. We really need to look at the vibe versus the reality.
Yeah, the psychological friction is the perfect starting point. The way a buyer feels when they look at a mortgage rate quote today is heavily influenced by a very specific and highly unusual period in our recent history.
Okay, let's unpack this, because I have a theory on the psychological trap that a lot of buyers might be stuck in right now. I think it is entirely about momentum and perception.
Okay, how so?
Well, it's like driving 100 miles per hour on the highway for hours. When you finally take the off-ramp and slow down to a perfectly normal 65 miles per hour, your brain tricks you.
Yeah, it feels like you're crawling.
It feels agonizingly slow, even though you are going the speed limit. And I wonder, is that why a 6.5% mortgage rate feels like the end of the world to people right now?
Absolutely. Because buyers are unconsciously anchoring their expectations to the pandemic anomaly. I mean, in 2020 and 2021, we saw rates hit 2.8%, 3%.
Which was incredible.
It was. But if we look at the data objectively, that period was a massive outlier. It was driven by a global crisis and unprecedented intervention by the Federal Reserve. It was not a normal functioning market.
Right.
If you look at the historical tracking from places like Freddie Mac and bank rate, as of May 2026, the 30-year fixed rate is sitting right around 6.4 to 6.51%.
Which, if you were trying to buy a house back in 2021 and got outbid, feels like an absolute punishment today.
It really does, but historically, it is remarkably average. Let's zoom out for some context here. In October of 1981, mortgage rates peaked at an astonishing 18.4%.
Wow, 18%.
Yeah. And even if we skip the 80s and look at a more stable economic period like the 1990s, rates dropped, but they only dropped into the 7% range. And that was largely because the dot-com bubble burst, which drove terrified stock investors into the safety of bonds, which pushed mortgage rates down.
Well, they were still in the sevens.
Exactly. They were still in the sevens. So what's fascinating here is that today's rate in the mid-sixes is historically fairly normal.
Well, I have to stop you there, because historical context is great for a textbook, but context doesn't pay the mortgage. Telling someone that rates were 18% in the 80s doesn't make their monthly payment in 2026 any easier to swallow.
You're exactly right, and that brings up a crucial distinction. The financial pain people are feeling isn't an illusion,
Right.
but the stress isn't coming from a 6.5% REIT in a vacuum. It's the layering effect.
Layering effect. Okay, what do you mean by that?
Well, you are dealing with a historically normal interest rate layered on top of dramatically higher home prices, aggressively rising homeowners' insurance costs, and higher property taxes.
Oh.
It's that cumulative compounding weight that is breaking the buyer's back, not just the interest rate itself.
Yeah, and because that compounding cost feels so heavy, I hear so many people saying we are on the brink of another 2008-style housing crash. I mean, people see record high prices, they feel the squeeze in their monthly budget, and they assume a bubble is just about to pop.
It's a really natural fear, but structurally, 2026 looks absolutely nothing like 2008. To understand why a crash isn't materializing, we have to look at what economists are calling the affordability paradox.
Well, let me push back on this paradox for a second. We've got a massive stack of research here, and honestly, the numbers seem to actively fight each other.
They do seem contradictory at first glance.
Right. Like, for instance, the Realtor.com 2026 forecast explicitly expects home prices to go up another 2.2% this year. They note the median price is sitting at a hefty $417,800.
Yep.
Yet, in the very same stack of research, the National Association of Realtors chief economist, Dr. Lawrence Yin, explicitly says home sales are being boosted by improved affordability.
I know, it sounds crazy.
How does that math possibly make sense to you if you're trying to buy right now? I mean, how can prices hit record highs, rates stay in the sixes, and affordability improve?
It sounds impossible, but it really comes down to the mechanism of nominal prices versus real prices.
Okay.
Nominal prices, that's the actual sticker price you see when you scroll through Zillow. Those are indeed up 2.2%. However, inflation is running at over 3%.
Wait, so the value of the dollar itself is dropping faster than the price of the house is rising?
Precisely. So in real inflation-adjusted terms, home prices are actually dropping. A 2.2% gain in a 3% inflation environment means the asset is technically getting cheaper relative to the broader economy.
That is wild to think about.
And there is a second, even more important mechanism at play here, which is wage growth. Right now, average wage growth is actually outpacing inflation.
Really?
Yeah. That means the average paycheck is growing slightly faster than the overall cost of living.
Okay, I understand the academic math. Technically, because incomes are rising faster than the inflation-adjusted cost of the house, the overall burden shrinks. But let's bring this back to reality for a second.
Sure.
Humans live on cash flow, not inflation-adjusted spreadsheets. When someone writes that mortgage check, it physically hurts more than it used to. There is a massive cognitive dissonance between what the spreadsheet says and what the bank account feels.
And that cognitive dissonance is the very core of the paradox. Your brain is telling you it's too expensive because the absolute number of dollars leaving your account is higher than ever.
Right.
But mathematically, the share of a median income required for a monthly housing payment is projected to fall below 30% in 2026. Specifically, it's expected to hit 29.3%.
Wow, below 30%.
Yes, and this is a massive milestone because 30% is the traditional threshold for housing affordability, and we haven't been below that line since 2022. The sticker price goes up, but the percentage of your actual labor required to buy it goes down.
That is a wild psychological hurdle to jump over. But let's circle back to that 2008 fear.
Okay.
If affordability is slowly, quietly healing underneath the surface, why are inventory levels still so weird? Like, why aren't we seeing a massive flood of foreclosures or panic selling to correct these high nominal prices?
Well, because the anatomy of today's market is the exact inverse of 2008. I mean, the 2008 crash was caused by a combination of dangerously loose lending, rampant speculation, and massive overbuilding.
Right, the subprime stuff.
Exactly. Adjustable rate mortgages reset, payments skyrocketed, and millions of people who had zero equity were forced to default. Today, lending standards have been incredibly strict for over a decade, but more importantly, we have the rate locking effect.
Which means nobody wants to sell the house they currently have.
Exactly. According to the data, 4 out of 5 homeowners right now have a mortgage rate below 6%. A massive chunk of those are sitting in the 3s or 4s.
Yeah, you're not giving that up.
No way. They are sitting on historic amounts of equity, and their monthly payment is incredibly low. So they simply are not moving unless forced by a major life event, like a death, a divorce, or a job relocation.
Got it. But I did see some loosening, right?
Yeah.
The data shows an 8.9% rise in active listings.
Yes, which provides some relief. But overall, inventory remains fundamentally constrained by homeowners who are financially bulletproof.
So what does this all mean? If the structural math is slowly healing and homeowners aren't in distress, Why is the day-to-day experience of trying to get a mortgage so chaotic?
It's the volatility.
Yeah. Mortgage rates haven't just been sitting flat. They've been bouncing around all year.
Hmm.
For instance, late in 2025, it looked like buyers were finally getting some real relief.
Right, the Fed cuts.
The Federal Reserve made cuts totaling 75 basis points, or 0.75%. Rates drifted down, ending 2025 around 6.66%, and they kept dropping into early 2026.
Yep.
You probably felt pretty optimistic if you were house hunting in January, but then rates spiked again. What is actually driving that volatility?
That volatility is entirely driven by macro wildcards. We really have to stop thinking of mortgage rates as a pure reflection of the housing market and start thinking of them as a mirror of global anxiety.
How so? Like, what's the actual connection there?
Let's look at how a 30-year mortgage is actually priced. Mortgage lenders don't just guess what rate to charge you, they base it heavily on the yield of the 10-year Treasury note.
Okay.
They use the 10-year bond because the average lifespan of a mortgage before someone either sells the house or refinances is about 10 years.
Oh, interesting. I didn't realize that.
Yeah. So if the safe, guaranteed return of a U.S. Treasury bond goes up, mortgage lenders immediately have to raise their rates to make lending to you worth the risk.
Okay, so what caused the 10-year Treasury yield to spike this spring?
Geopolitics and domestic uncertainty. The bank rate data clearly maps this out. In February 2026, the conflict with Iran escalated, severely disrupting the global oil trade.
Right.
When oil shipments are threatened, the cost of energy goes up, which means inflation fears immediately spike.
And when investors fear inflation, they demand higher yields on bonds to protect their money.
Exactly. So the 10-year Treasury yield shoots up. Because mortgage rates are tied directly to those yields, mortgage rates were yanked right back up to around 6.4% by May, purely because of a conflict overseas.
And it isn't just international conflict, right? We have domestic policy uncertainty feeding into that yield, too.
Very much so.
Because as of May 15th, 2026, Federal Reserve Chair Jerome Powell's term officially ended, and no successor was immediately named. The bond market absolutely hates a vacuum.
Oh, they hate it. When lenders don't know who is going to be steering the monetary ship for the United States, they price in a risk premium.
They charge you more for their own uncertainty.
Exactly. They charge you, the borrower, a slightly higher interest rate just to cover their own anxiety about future inflation. That is exactly how high-level macroeconomic uncertainty hits your literal kitchen table.
So if you are a buyer trying to navigate a market that's heavily manipulated by global oil conflicts and vacant Federal Reserve seats, how do you even adapt? Because the data shows people are still buying homes. What are the workarounds here?
Well, if we connect this to the bigger picture, a massive part of the adaptation involves new construction. Builders have essentially become the modern real estate cheat code.
I was looking at the Realtor.com data on this, and it really surprised me. Historically, a brand new house always carried a premium. It was, the luxury turnkey option.
Right, usually.
But right now, the new construction price per square foot is actually falling below the price of existing homes.
Huh.
Why is a brand new house suddenly the more economical option?
Because builders operate on a completely different financial reality than a regular homeowner.
Not so.
Well, a guy with a 3% mortgage rate can just sit on his couch and stubbornly refuse to lower his asking price for 6 months. He's not losing anything. A commercial builder cannot sit on completed inventory. They finance the construction with short-term loans, so they bleed cash every single day a completed house sits empty.
Oh, wow. So they have to move it.
To clear that inventory, they're highly motivated to make the math work for you.
And they aren't just doing that by slashing the sticker price, right? They are offering mortgage rate buydowns.
Yes, and this is where understanding the mechanism is really crucial. A regular seller can't afford to change your interest rate, but a major builder can take a chunk of their corporate profit margin up front, hand it directly to the lender, and essentially subsidize your interest rate for the first 2 or 3 years of your loan.
It is so smart.
Yeah, they are using their deep pockets to manufacture a lower monthly payment for you, making a new build affordable in a way the resale market just can't match right now.
That is a phenomenal strategy if you are actively in the market and want to buy right now. But what if you're looking at the 6.4% rate, the $417,000 median price, all the geopolitical chaos, and you just say, no, I'm out. I am not playing this game.
Right.
Are you just doomed to tread water and bleed money in the rental market?
Not at all. And this is a really vital piece of the puzzle. If you aren't ready to buy, the rental market isn't a trap right now. It is functioning as a very safe holding pattern where you can land and wait out the storm.
Really? because rents have been so high.
They have. But over the last couple of years, builders weren't just building single-family homes. There was a massive multifamily construction pipeline. A huge number of apartment complexes were greenlit during the pandemic boom.
And all those units are finally finishing construction and hitting the market at the same time.
Exactly. That massive influx of new apartments is driving the national rental vacancy rate up to 7.2%. Because of that supply glut, landlords are losing their pricing power.
Oh, so they have to compete for you.
Yes. As a result, national rents are actually dropping by 1.0% in 2026.
Which means if you decide to sit on the sidelines, you aren't being punished by skyrocketing rent. You actually have the mobility and the affordability to save your cash, watch the market, and wait for the right moment in your own life to buy.
Exactly. You have options. You don't have to force a bad deal.
Okay, so we've established that the everyday housing market is entirely held hostage by mortgage rates, bond yields, and debt affordability. But what happens when you remove debt from the equation completely?
Well, then you get a completely different housing reality.
Yes. Here's where it gets really interesting. This jumped out of the research as such a vivid contrast to everything else we've discussed so far. We are looking at a luxury micro-market on the Highlands-Cashiers Plateau in the mountains of North Carolina.
Yeah, places like Highlands-Cashiers, Sapphire, Lake Toxaway.
Exactly. And the data here paints a completely different picture. This is a market heavily driven by cash purchases, specialized portfolio lending, and second home ownership.
It is a perfect case study in behavioral economics. I mean, when we talk about the national market, we are talking about people buying shelter.
Right.
They're buying primary residences that are heavily dependent on 30-year fixed-rate financing. The buyers in the Highlands-Cashiers market are playing an entirely different game.
They aren't looking for a starter home.
No. They are not looking for short-term speculative appreciation. They aren't trying to flip a house in 2 years. They are acquiring legacy assets, and frankly, they're buying climate and lifestyle relief.
That's fascinating. The research highlights that these buyers are specifically escaping. They are fleeing the intense heat, the density, and the brutal congestion of major Sunbelt cities.
Yeah.
We are talking about affluent buyers from Atlanta, Charlotte, Nashville, Texas, and heavily from South Florida. They are trading 100-degree concrete for cooler summer elevations, understated luxury, and highly refined private mountain golf communities.
And this changes the underlying physics of the market entirely.
How so?
When a housing market is driven by cash and concentrated wealth, it becomes insulated from the daily panic over 10-year Treasury yields and inflation data. If you don't need a mortgage, you really don't care who the Federal Reserve Chair is.
That's a great point. But I have to ask, are these cash buyers completely immune to market cycles? Like, does the stock market dip or a recession just bounce off of them?
Well, no, they are definitely not immune to broader economic cycles. A major economic downturn or a massive drop in the stock market will absolutely slow down a luxury second home market because their wealth is often tied to equities and business ownership.
Right, their portfolios take a hit.
But here is why the market behaves differently. Their motivations insulate them from panic selling.
Because they aren't forced to sell if they lose a job.
Exactly. And because they are buying a property to be enjoyed multi-generationally, to have Thanksgiving with their kids or to spend the entire summer escaping the Florida heat, they don't panic when the stock market hiccups.
They just hold it.
They hold the asset. Because of that long-term hold mentality, inventory in these micro markets remains incredibly tight, which protects the property values even during broader economic downturns.
They aren't day trading real estate. They're buying a permanent fixture for their family.
Exactly. The sources specifically highlight professionals like Carrie Bateman, who curates a private collection of these exact types of properties on the plateau.
Oh.
We are talking about mountain estates, golf community homes, and luxury retreats ranging from $3 million to over $8 million. The buyers engaging with those properties are looking to preserve wealth while simultaneously acquiring a tangible lifestyle asset.
That makes total sense.
They are optimizing for joy and family legacy, not just trying to maximize a return percentage on a spreadsheet.
It is genuinely fascinating to see how the rules of the game change entirely based on the objective of the buyer. So let's pull all of this
It
together.
sounds good.
We've gone from the 18% rates of the 1980s through the trauma of 2008, deep into the mathematical paradox of 2020 affordability, and up into the isolated, cash-driven luxury of the North Carolina mountains.
It's been a journey.
It has. What is the overarching lesson here for anyone trying to navigate this landscape?
I think the primary lesson is that real estate never moves in a straight line.
Right.
It moves in complex cycles. It always has, and it always will.
And if you wait for the perfect moment, if you sit around waiting for interest rates to hit rock bottom, prices to crash, and the economy to be perfectly stable, you are going to be waiting forever.
Yeah.
Because by the time all those indicators flash green, the opportunity is usually already gone, swallowed up by a massive flood of other buyers who are waiting for that exact same signal.
Exactly. Whether you are hunting for a builder rate buy down on a starter home in the suburbs, or you are evaluating a legacy estate on the Highlands Plateau, the strategy is ultimately the same.
Which is?
You shouldn't try to time the market, you should time your life.
We'll like that.
Does the purchase make sense for your family right now? Does the monthly payment or the cash outlay fit your financial reality today? If the answer is yes, the day-to-day macroeconomic volatility matters a lot less over a 10-year timeline.
Time your life, not the market. I love that. We started this deep dive talking about how the expectation of economic precision, that clean textbook physics of the market, is broken right now.
Yeah.
It's confusing out there, but hopefully we've untangled some of the mechanisms for you today. The data isn't actually as scary as the headlines want you to believe once you understand how the machine actually works.
It rarely is. But if we connect this entire discussion to the bigger picture, the data from 2026 leaves us with one incredibly provocative question to consider.
Okay, lay it on me.
Well, we just spent time detailing a national market struggling with debt affordability and bond yields, and then we contrasted it with the Highlands Plateau operating purely on cash and legacy.
Right.
As climate factors, extreme heat, and urban congestion increasingly push affluent buyers toward remote, high-elevation, high-amenity legacy markets, are we watching the creation of two entirely separate housing economies?
Wow. That is a heavy thought.
Think about it. One economy dictated strictly by the daily whims of the Federal Reserve, the 10-year Treasury yield, and fractional changes in debt affordability.
And the other.
And another, entirely insulated reality driven purely by climate refuge, cash, and generational wealth. And if those two economies are diverging permanently, which economy are you preparing for?